Okay, good morning. Welcome. Jay here. This is smarthelping.com. Well, it might be good morning, evening, afternoon, whatever. Got a new financial model for hotel analysis. It's based on the version I built a couple years ago, except it has a whole bunch of added bells and whistles, some simplifications of things, and I think it's extremely useful for either acquisitions or new development or construction projects. I'm going to go through and just show you what's on each tab really quickly, and then after that, I'll take more time and actually walk through all the different inputs on all the tabs. But just so you can get a quick overview of the whole model, we have the global control tab here with all our high-level assumptions, debt assumptions, some sensitivity tables, sources and uses summary, project level returns, and if you have a joint venture, LP and GP returns, and the IRR hurdle that drives that. Construction costs, you got three phases plus an extra development phase. You can put in your cost per month. You've also got a development fee down there. Acquisition and management fees, loan amortization schedules, revenue assumptions, and we've added revenue streams to the hotel model: food and beverage, branded residence sales, and event revenue. Staffing assumptions, we've added variable staff here, that's new. Other costs, this is the same, just fixed monthly costs. Sources and uses, this is all new, very detailed. Took me quite a while to make sure all this always works no matter what your assumptions are. There are a ton of GP fees. It doesn't mean you have to use them all, but a lot of different deals use a lot of different types of GP fee, so this is flexible enough to handle most without you having to add your own logic in, which is nice. Uh, Visuals, we added a couple here. Um, One thing I love about this model is you don't have any hidden tough formulas to figure out or name ranges or anything like that. It's very easy. If you did want to modify it, you can go in, you can follow all the logic, it all makes sense. Um, there's nothing where like, oh, I did something to make something work, where it's like, because a lot of underwriting models you get that someone else built, it can be hard at times to follow. This is very easy to follow. Uh, all the formulas linked together. There's no redundancy that's not needed. Um, I think just the right amount of summary information um, to get you to the analysis you want. Monthly detail, this is where everything kind of comes together in one spot to get to cash flow, so you can see everything that affects cash flow. Um, Annual detail, and then we got the cash flow waterfalls at the end. These are using the assumptions from the global control for your waterfall. And you got an annual summary of that as well. Then we have all our dynamic logic at the end to do all the fun stuff with the residency sales and dynamic cash flow collections. You know, if you sell one, you might not collect the cash flow up front. There might be a period of collections, so you can define that right here. Anyway, let's get into the details. So, we start off company name. This doesn't go anywhere now. It's just for reference purposes. Launch year. If you change the launch year, it will affect the drop-down dates. For example, in staffing, these start months will be affected. Um, Same with other costs. So know that. The dates on the loan tabs are all automatic. You don't need to change any of those. They work just as they're supposed to, and they'll update mainly just to know when your exit is happening. It will trigger repayment. So you don't need to touch anything on these tabs except for we'll get into it, but you got your draw amounts here for construction loans. But we'll get into that. So you get your drop down here for your exit month, because you might not want to do a full 10 years. You could do 5 years, 7, 3 years, what have you. Um, and then as you're adjusting these dates, make sure your other assumptions make sense with that. Uh, just, just as you're using any model, you would not put in something that doesn't make any sense. Uh, so if this were like a 5 year, you could do 3, 4, 5, 6 to 2027. You wouldn't have a refi happening after your end date here. So your refi month wouldn't be like month 72 if you're ending in month 72, or month 60 in this case. Um, Exit cap rate, just going to take your NOI, which is going to include event revenues, bookings revenues, and food and beverage. And it's going to divide the NOI by this percentage to get your valuation at exit. Selling costs will reduce off of that to get your net exit proceeds. Purchase price, what you're going to buy if you are purchasing. Now, this doesn't have to be acquisition. It could be completely new construction. In that case, you can zero this out, and then you'll put assumptions for your construction costs here on the construction cost tab. Acquisition and management fee also has some other things. If you are making a purchase, so let's say we're buying a $150 million property, and we also want to do some renovations, so you can do renovations cost per unit or key based on how many keys the hotel is, as well as what other capex, which is a hard-coded input. And then these renovations here are simply going to follow whatever start month you put in here and the length of the renovation period, and it'll just evenly split that cost over that time, as you can see on the monthly detail that's happening right here in this row for renovations. For the equity distributions, this is so I did it. I've had a lot of clients like the cash management feature where you can see all the cash flows of the entire operation here in this row, and then to manage the cash flow, and especially if you have equity contributions happening at possibly different times, or it can be all up front, doesn't matter, whichever. And then you want to define possibly manual distributions, or you can also define the month that automatic distributions happen and keep a minimum available amount in the operating account. You can do that as well. Um, Clients like this. It's very good. You can adjust it with your strategy. It's good to show investors when they might be getting money back as well. And it follows along with the cash flow of the actual underlying operations. You want to keep your operating account balance above zero. So for example, if I plugged in zero here, there's no equity contribution. You can see, well, we're going to be short about $70 million. So you got to put in at least that amount. And there's a summary on the global control here that shows you the minimum equity required versus what was actually invested and the variance. Now, if you wanted to put the exact amount, you could just copy this here, paste it in the first month, and that whatever that number is, I'm pasting values only. If you use the minimum, you're always going to solve for a zero. It's slightly, it might be 0 point, some very small number, but it's basically zero. You'll be solving for zero balance here if you do that, in whatever month that happens. And then this equity investments and then the distributions will flow directly into your cash in and out for your IRR hurdle waterfall for the LP and GP. In this case, I have distributions happening. I put month 121, which means this automatic never takes effect. And so if you have that, then whenever the actual exit month is, in this case December 2027, it just clears out the whole operating account in that month. So you can see the distributions are going to be this 95, 809, and then that would be it. So you can see here on the monthly waterfall there, we manually did these 20 million as we sold off the residencies, homes basically, and then we have that final amount there in 160. And the annual cash flow summary, you can see a little bit more detail. or you can see it's less detailed, but you can see everything all at once here happening for the LP and GP. Okay. As we go along here, so let's say I put this at month. Let's go for a full 10 years. Let's say we want to start distributing automatically at month 60. We want to keep 5 million at least in the bank account. So now, if we go back to here, you can see, okay, we have enough cash for operations. Start selling some of the initial homes that we were building here, collecting cash. Here's the operating account. It gets around 38 million, and then it's stabilized. We start to go up a little bit as the NOI cash flow goes positive. You can see here there's a acquisition loans all we have right now for debt service, and here's our EBITDA, NOI, and then we start distributing in month 60. But you see we distributed 35 million to get down to 5. Then we had a couple negative months here, which is fine. We just don't distribute anything, and this is all happening automatically. And then once we get above 5 million, we just do distributions. And the reason why there's some negatives here, even though we're stabilized, is seasonality. So here we go with this up and down, and then we finally have enough to continue distributions here while keeping our 5 million balance through to the end. Then we have an exit. So this all it's going to change as your assumptions change. So you always want to review this section, the cash flow management section, after you change your assumptions to make sure it still matches what you are planning on doing or how it changes, because these numbers will also affect the LP and GP returns here, because that amount invested is going to be whatever you put in. Now the project level, if you're not doing LPGP, this is just what you want to look at, the project level returns. This is just looking at this cash flow row here. So it has nothing to do with the cash flow management. It's just assuming, here's all your negative and positive cash flows. Here is what that looks like. I believe, let me double check that actually. Monthly. Actually, no. So forget what I just said. This equity investment does drive this amount here, total invested, so it's not automatic. And one of the reasons why I did that is because I didn't want a circular reference with asset under management fees for the GP. If we would have made that percentage based on the equity raised and then made the equity raised based on the min cash position with a formula, you get a circular reference error. So the easiest way is to have the cash invested be a manual input. And then if you're going to do that, you might as well do this whole cash management thing. Now there are other ways if you wanted to do an annual only version where all the cash is up front no matter what. And then the asset management fee might be based either manually input or based on revenues or something else. You could do it that way and then have annual only periods. Or there's a lot of ways to do it. This is, in my mind, and from what I work with clients, this is the best way to do it. That gives you the most granularity and the most accuracy with returns and the timing of things. So this is how we've done it here. But if you want it done differently, I'm available for custom work to do anything that you need or structure it however you want. All right, so those are some big pieces of this. So I wanted to touch on those, the dynamics of that. Now, for debt assumptions, we have our acquisition loan, 2 construction loan assumptions, and refi assumptions. In this case, we're just doing an acquisition for 150 million. So you could put in 60% LTV here, or what have you. That gives you a loan amount, and you could see the acquisition loan. We have an interest-only period, and then we go into P&I, and then that's just run through to the end of the forecast period, and then repaid whatever balance is left. Now in this, you can obviously define closing costs, an IO period, the interest, which is interest only, the interest only rate if it's different, and then you can also define if you want to end the loan after the IO period or not. Usually it'll be no, and usually it'll just convert to a permanent loan with an amortization in term as well as a new interest rate. Interest rates could be the same, they could be different here. I've seen it both ways. The construction loans, a little bit uh, different. So for those on L2 and L3 tabs, you can define the draw amount here. And I put the operating account balance in column A so you can see how when you put in draw amounts here it'll change, which is much more relevant when you have costs happening over time and you want to draw different amounts because your interest rate is going to be lower or higher if you draw more or less in a given month. So you could manage that all right here. And we'll get into a construction example after I get through with all these explaining everything with the acquisition version, using just an acquisition. I'll do this version as well. But for the construction, you define the draw amounts on the L2 and L3 tabs. Then you put closing cost percentage, which will be the total amount of the loan drawn. IO period for that, the IO rate. Usually construction loans will have interest only periods until you're done, and then it'll convert to a permanent loan. So you usually hit yes on the switch to permanent, and then amortization term of that loan and the interest rate. So construction loan 1 and 2 both work exactly the same way. Then we have the refi, which you can define yes or no if you want to refinance. If yes, you see it changes all the numbers. I could define the month I'm going to refi in. If I put 61, that means month or year 5, or sorry, year 6, meaning you do 5 full years of these loans, and then first month of year 6 you're going to refi, meaning in this case it means there's some valuation. I just did it on the trailing 12-month NOI of the refi month, whatever that is. In this case it's 8.6 million. At an 8% cap, that's $108 million value. If you do 25% LTV, loan to value, you're going to take out a $27 million loan, pay back all of these construction acquisition loans potentially, and then you've got closing costs on that. And then that can possibly have an interest only period. Really often it won't. It'll just be straight to permanent amortization. So you can see that's happening there in month 61. So if we go to refi, you can see that's happening here. Now with these assumptions, in this case, we're taking out way more money than we have. So we're negative here. We don't want to borrow that amount. We have and pay this amount back at that time. You can see here we just don't have enough to do that. It doesn't make sense. So you'd have to change some terms or change the initial LTV, or possibly maybe make this a 75% loan to value. See what that looks like. Okay, that's better. Now we're positive just barely, and then we still are able to move up to our 5 million minimum balance and maintain that the whole time. So this 81 million goes to pay back the loan. We also had some operating cash flows in there. Remember, this is how you manage it. So in month 60, 61, we have the refi coming in, the initial acquisition loan getting paid back. So it's essentially a wash almost, not a whole huge cash effect. And so it really wouldn't make much sense to do it unless the interest rate was super low and you're just trying to have a lower debt service coverage, or sorry, higher coverage. But usually refis will happen to return equity to investors, so you want more. Maybe we'll do a 6% cap. Okay, now in that case you've got 25 million you can distribute and still stay above your 5 million minimum there. So that's a little bit better. But your debt service will be higher. Here now it's 684 a month, slightly higher than your NOI. So you've got negative cash flows now for a bit. If you look at the annual, you could see on the annual you're still positive on the annualized amount, which is good. So once you're negative, so much you're positive. Anyway, that's how you can play with that. And I find people get more comfortable with a financial model when they see it being used. So that's why I'm kind of going through and playing with numbers and showing you like how I would adjust things and see how numbers change. And notice right now the main focus is on operations. I haven't even looked at LP, GP, IRRs or anything. So that's the refinance loan. Um, Now, once you adjust all of those assumptions, I would skip this for now, skip these returns. Let's go to construction costs. So here the idea was if you are doing construction, usually those costs happen over time, not all at once. So you have 3 sections, phases, and an extra phase here to define costs. These costs are just going to hit cash flow whatever amount you put in here. So let's say I've got 5 million and that's my cost for the first 7 months. I got, $35 million. All that's going to do is reduce my cash available by that amount over that time. So you can see that construction cost hitting here is just reducing cash flow. And obviously I need to change something, either take out loans for that or raise more money. Now if I want to take out loans, I go here and see, okay, here's my operating account. I'm sorry, go to L2. Here's my operating account. I can draw. So let's say, we know we need 20 million, but not right away. Let's say we draw 2 million here. And note, while you're drawing this, you're going to be paying interest. Not a ton compared to the size, but it is, accounted for. 2 million here, then maybe 7 million. Now you still need 6 million the next month. Maybe we'll do, and this is to minimize interest. I mean, technically you could just do as close to the amount you need as possible. Oh, what happened there? So that went negative, probably because of the closing costs made this less. Because the total loan amount is going to go multiplied by this closing cost number and hit in month 1. If you look at the monthly detail, closing costs on construction loan 1 are right here, which is going to hit whenever the very first draw is, which is automatically calculated. Right here I did some logic to figure that out, and it's just based on whatever first draw happens here. Anyway, so we need a little bit more in this first amount, or we'll need more equity actually, so I'm not going to change that. Let's do 6 million. Actually, we don't need 8, 6 again. Okay, so that gives us a little buffer on the operating account, but we have now to raise a little bit more cash because of those closing costs on the loan. So let's go over here and adjust this. There we go. So that gets us back to our 0 operating account balance, which is meaning we raised just enough equity to cover all our assumptions. If I go to L2, you can see here, and we now have our loans here. So we only had to get a little bit more equity, and we did 26 million in debt to cover these construction costs that we just added in. So you can see in the model, you're kind of always looking at, you're thinking about your sources and uses. And I'm going to get into in depth. I feel like this model probably has the best sources and uses logic for something that has ongoing costs up to a certain point before you stabilize, which is exactly good for hotel construction projects. But also it works for acquisition. But mainly the nice thing about this is you can do it with either or, and it works perfectly. But this has really good logic that I'm going to go through. here in a little bit. So construction costs, and again, this logic is the same. So as you put in costs for all the different phases, it hits the cash flow, and you can manage it. You can do two separate line of credits here, or construction loans as you're drawing. Again, you can configure the assumptions about those loans on the global control tab here. Interest rates and then terms when you switch over to a permanent. The other thing you can do, so let's go to L3 here since we didn't use this construction loan. This can be, it doesn't have to be a construction loan. So if I go to L3 on the global control, which is construction loan 2, and I'm going to actually put L1 tab or L2 tab just so it's super clear. You can make it an initial loan. Like say you wanted to do, you're going to do an acquisition loan plus maybe a seller finance. You can make the IO period 0. Switch to amortization, yes. Or it could be an interest-only loan. Like if it's an IO, you could do maybe a 60-month. Let me double check one. Okay, good. 60-month, and then if we go to L3 here, just put the draw amount in the first month of how much you're going to take out, maybe 10 million. Okay, so we see our cash balance just went up by 10 million, and we have interest only happening for 5 years, then we repay that there. And you could line that up with your refi if you want, or you could just if it's not an interest only period, you could put 0 here, and it could just be a regular amortization loan. So you can see 10 million. Let's mark switch to amortization as a yes. And now you can see in L3 we've got principal and interest coming out, and it's just a regular term loan. So you can use those as construction loans that happen over time, or you can use them as initial loans where there's just an initial draw amount, and then interest and principal being paid back based on terms here. So you can do that with either of the construction loans as well. So it gives you even more flexibility if you're doing a more complex acquisition or just more complex debt structures. So super, in my mind, super flexible for a bunch of different situations. Okay, so that's the debt, construction costs, acquisition and management fees. So here we already went through the renovation. There's other costs here. A lot of these are just like, so third-party reporters, title and escrow fees, legal and professional services, other upfront costs. These are all happening in month 1. Closing costs on your acquisition loan. And then we have a bunch of GP fees, acquisition fee, CapEx fee, debt placement fee for all the different loans, for the refi, organizational setup fee, guarantor fee, leasing, and fees on exit of the sales, and other management fees. We've got 2 asset management fee options. You could use one or both or none. This is just based on a percentage of the total funds raised over time. So it'll be this percentage divided by 12 times whatever has been raised. If you look here, let's see, what was that? Asset management fee 1. Let me put a little 1 next to that, and 2 so it can be identified over here. So you see here it's taking that fee times the amount divided by 12. And we put 0%. Let me put, maybe if it was 0.5. Now remember, our minimum equity required is based on the current assumptions, but if you were to raise this and then make your asset management fee based on this percentage of this, you are always going to have a little bit higher, so you can, for example, let's zero this out and say we've got a minimum cash required right now of 69,894,000. We put it into the first month. We're still short 87,000. Why is that? Because this is percentage is based on this amount. And so when there was zero in here, the minimum equity didn't know any amounts there. So we're 87,000 short, which is just the amounts up to this min cash position. So you want to do a little bit slightly more to cover that. If you want exactly, you can just hit an equals in the front here and then add the amount 87,368. It'll be slightly less. You could do it one more time. And there's no automated way to do this that I know of. So either you manually put in a little bit more because you know you're going to have to cover that fee, or you do it this way. And as you keep doing it, you'll get closer and closer to zero. So I had to do 3 extra ones there, and now it's just enough to cover that fee as well. So there's that asset management fee. There's also an asset management fee that's based on total revenues, which is the second one, so percentage of total revenue. It does not include residency sales because there's already fees against that here. And then property management fee, this is not a GP fee, and it hits above the net operating income. All these other fees are all these other fees are below NOI, so it has nothing to do with operations. But the property management fee is above NOI. It's not a GP fee, and that's just percentage of total revenue as well. And then you get your reserve here, 500,000. Now for these two, just because they're below NOI, it still is part of the project cost, so it means it goes towards the minimum equity you're going to raise if you're raising between a GP and LP, and then whatever your contribution rates are between GP and LP, they'll contribute that amount, but it'll all end up flowing, as we see in our cash flow waterfall, as fee income to the GP. But it goes as a project cost. All right, so that's the acquisition and management fee section. We talked about the loans pretty in depth, the refi, revenue assumptions. Okay, so let's actually think about the hotel itself. So you've got up to 20 room types, and this is easy to extend if you wanted to do it. You just follow the formulas, or I can do it as much as you want, but it's 20 unique room types you can enter. The start month that they go live, which is important if you're doing the phase-based model. The count of rooms of each type, the base daily rate, and then off of the base daily rate you can define the variation of that rate over a 12-month period, because high and low seasons you might have different the base daily rate or the daily rate could change when it's more busy or less busy. So you define a percentage variance there. And all this means is 100% means 250. 90% means 90% of 250. 110% would mean 10% more. And you see the daily rates per seasonality. It's all calculated right here to show you as you change these what actual number daily rate are you getting for the given month. Then you could adjust for seasonality here or occupancy separately. So you've got your rate, the rate you're charging over time here, and then you have the occupancy, which is to define how many of these rooms are actually occupied over the course of a month on average. And you can define that, and that can vary in each month as well. And then we can do an improvement in that each year over 10 years. Since if you want to, especially in the first 2 to 4 years, as you're ramping up and stabilizing, this might be lower, and then it gets to a stabilized number. Then maybe it stops going up, and you level it out at some point. You can also, to make sure this percentage never accidentally takes something over a percentage, you could put a maximum stabilized occupancy right here, and in that case, no row ever goes or column ever goes above that. So daily rate adjustments over the course of a year, and then seasonality adjustments on top of that. Now, whatever you put in for these variances, this will apply to that room type for the entire 10 years, whatever this is. And then this obviously can vary in each year and within the year based on these percentages. So those are your booking revenues. That's how you'll define that. And you can also define the average annual room rate increase. So this will apply to these initial numbers and then increase by 2.5% per year in this case. You can see on the monthly detail, we have our revenue growth factor right there. That's driving all that. And here's the calculations actually happening from everything I just went through on that revenue section, and that gets you your booking revenue. All right, next up we have food and beverage. So this is pretty simple. You just define expected annual food and beverage revenue, when that starts, the start month number, and then your food and beverage OPEX is simply a percentage of the hotel booking revenue. So that's kind of a top down there. So this will be revenue, this will be expenses for food and beverage. And you can look on the monthly detail. The revenue is right here, and the food and beverage OPEX is right here. And you can make sure that kind of lines up with what you think it will be. Now there's also seasonality, so that 2.5 million might not all happen in evenly over the year. You can define how much of the 2.5 you're going to earn over a 12-month period. This should always add up to 100%, otherwise you won't have 2.5 million in revenue. And then this will grow. This 2.5 million will also grow at whatever rate you put in here for your annual room rate increase. Okay, then we have branded residence. There's a little bit of complexity going on with this one. So there's up to 3 types. You could define the average sale price of each residence. So this would be if you're constructing like new homes in the area and you're going to sell them off. Or, you know, it could be maybe multifamily buildings around the hotel or what have you. Just the point is you're going to build them and sell them right away without collecting any rents. So you got up to 3 types. Here's the sales price. There's selling costs for each one, and then the percentage of the sales price that you actually collect when the sale initiates, which could happen over time. And there's some cash flow offsets there because you might be using the sales of these to continue to construct the hotel if you're doing construction, which you'll plan out these costs, you know, to match up with your sales if you want to minimize the equity you need. Now the other part is with this, so branded residence, you got 3 types. On the monthly detail in row 115 to 17, you can define the count of each residence type that you're selling. Like how much, so in this case we've got 4, 4, and 6, total 14. And you can change those to any number, you know, if I put in 5 here, what have you. That will then drive your revenues and the initial month. So if I put 5 in here in month 5, then in month 5 I'm getting 10% for all of those. So it'd be 10% times 5 times 20 million would be the amount of cash I get, less any selling fees. And then it works like that for all the types and over time. And then here's some math for how that, or the result of that happening. Then we've got total revenue is just the total of all of those different things we just went over. We also have meals and entertainment. And this, you have an annual revenue amount, so whatever that is. In here I just put 850,000. When that 850,000 is expected to be collected over the course of a year. Annual growth of it, which is separate from this one. And then estimated margin here, 65, which means that your net profit from M&E events, assuming you have some extra costs that go into that, you're making 65% of the 850 as profit. And then the start month of those event assumption or revenues also. On the monthly detail, that is right here, M&E event revenue. There's the amount, and then the costs happen right here based on that margin calculation. And then that just adds to the total net operating income. Now, net operating income, we are not including residency sales, but we are including everything else. So essentially the hotel operations. But we are showing total EBITDA in as residency sales because we have to show that income somewhere. In this case, we're showing it here, and the cash because it has to go to cash flow. All right, so that's revenue. Staffing, you could do the start month of each staff type, a whole bunch of different staff types, the count of each staff type, the starting monthly salary. Keep in mind that's a monthly salary amount, not annualized. And then the percentage of payroll benefits, and then the percentage increase in salaries over time. You also have some more staffing positions here. Same logic, the start month, how many there are, the monthly salary, the payroll tax benefit percentages. And then here's a new piece that I didn't have in the original hotel model, which is the variable staffing. So you can say how many you need per key, and then as you're scaling up, your rooms, opening up more rooms, that will adjust your staff amount, the monthly salary, and then the annual cost growth of that. So from the original hotel model, the new things are, well, let's do the final piece before we go over that. So we've got other costs as well, so utilities, legal fees, just other fixed monthly costs. You can put the start month and the monthly cost there, and that'll in increase. So if I do utilities at 35,000 a year or a month, this is what it is, and it's starting in June of 2024. The model starts in 2023, so technically that's year 2. So year 2, that's the monthly amount that's hitting, and so forth. As we go on, it goes up by 2%. And that works for all of these the same way. Okay, so yeah, so differences. So the variable staff is an update. The revenue assumptions, obviously the old hotel model had nothing for food and beverage, nothing for branded residencies, nothing for M&E. It did have the cash flow waterfalls, but it did not have the cash flow management feature down here. It just did positive or negative cash flows for contributions or distributions. So this is a little bit more sophisticated on the cash flow side. It did not have all these complexities for acquisition and management fees. The construction loans, it was not this granular, and it didn't give you the flexibility. It didn't have any sources and uses, didn't have these sensitivity tables. We added a couple of visualizations that it didn't have before. And now you've obviously got breakdown from revenue from hotel versus residency sales. Sources and uses, didn't have that. So this is a pretty cool chart. We added a revenue per available room, which is a key metric for a lot of hotels, monthly and annual. And then I did this cash in and out chart, which this is kind of like a sources and uses for each year. It shows you cash in and out based on whatever it is in each year. Okay, and this annual cash flow, let me look at my assumptions. Let's look at where we are at, because I changed a couple things. Oh, I know what happened. So let me zero this out. We added more residency sales. Let me zero out these distributions as well. Okay. So we need now 69 million, so that's actually not a huge difference. Slightly more, we'll put 70. Okay, so we got a little buffer. Now we had a lot of extra cash come in. Oh, I see, right. So we could potentially, so with those residency sales, now here obviously I haven't attached them to the construction costs. There's no direct connection between this, the branded residence, like what you're selling it for and how many you're building and selling. Like here you can define how many of them you're selling, but you have to manually put in the expected costs for those building those things here. I didn't do, now you could have done like a cost per unit and just did some multiplication, but there's so many factors. I thought the easiest use case is, okay, here's the construction phases. Some could be for the hotel, some could be for the residencies, and just put whatever the cost is going to be over time. Because you could have terms with the developer, or there could be all kinds of different things. But the key is for your operations, just enter your monthly costs for construction here, and then that has to match what how many you're actually selling. Uh, okay, so in this case now we got a whole bunch of extra cash. If you had this, you'd either use it for construction or you could distribute it back to investors and manually put in some distributions here. Um, here we got a bunch of extra, so we can distribute a bit and still keep some for either burn or operations or what have you. Um, okay, now we go back to that visual there, so now it's a little bit more balanced out. Um, but you can see the point of how you can play with the numbers. I don't actually know if I went over the executive summary, but this shows each of the revenue streams annualized, not annualized, but the annual amount of each. Your costs of the main cost items, total expenses, NOI, EBITDA, other cash flow items, purchase price, capex, debt service, loan payoffs, loan proceeds, GP fees, um, other costs, and then reserve, and then the project level returns, and some charts. Okay, let's talk about sources and uses because this is unique. And what I've done, so you can see on the monthly detail, we have this kind of minimum cash required thing that happens. So the sources and uses, not everything is going to be upfront. It can be over time, and the costs that happen over time that affect your minimum equity required, that can change based on the assumptions. So for the sources and uses, I actually automated all of the different costs that can happen in month, possibly in other months besides month one, so that it looks at, automatically figures out what's the month that the minimum cash happens, and then it will calculate what in that period is driving equity requirements. So all these amounts for the uses are all amounts that affect how much cash you're going to need. And then once you stabilize, in this case it's after month 3, now all those ongoing costs after that are stabilized. So it means they're either being funded by net residency sales, just general operations, NOI, or loans or what have you. But the point is they're not affecting how much cash you need. And for our sources and uses, the main point of this is to show how much cash do you need in equity and loans, and then how much of what is requiring you to raise this much money. And so these are all the things that go into your money raised or sourced. Hence, sources and uses. So this all balances and it's all dynamic, and I've tested it quite a bit and it's working perfectly. You can see here we've got use of net operating income negative, meaning that we have 24 million in negative operations that we have to cover, so that's going to affect how much cash we need. We've also got a surplus. Now in this case we've raised 17,000 more, and so that's just saying like, okay, we raised 17,000 more here, so there's the 17. It's not necessarily a negative number, but it's basically the difference between the minimum you need and then what you actually raised. So it should never be less than the minimum, but it might be more if you want a buffer on top of your reserve. Also, you can see like construction and development, there's 15 million worth before you stabilize. That's going into here. Now you will use the residency sales if it affects your cash. Now obviously you might use it, you may or may not use it after the minimum cash if you're directly or evenly defining the construction costs so they line directly up with this and they don't create you to go into a further negative cash position, then it won't be on the sources and uses. It will be in the cash flow, obviously, though, and you can see the offsets happening. So, okay, here's my cash coming in from residency sales. Here's my construction costs happening down here. Right here, and they offset accordingly. If your minimum cash position is like later for whatever reason, then up to that minimum, whatever residency sales you're using to offset the construction costs will be included in sources and uses. Otherwise, it's not. If it happens after, and that's just saying that you're covered, and that's not affecting how much equity you need. And so we have a detailed version of sources and uses here. We have the summary here, which I try to roll up some of these items. So purchase price, CapEx, third party and closing, debt service, GP fee, reserve, and then operations if negative, operations if positive, because they could be a source or a use depending, and then the surplus of equity raised is always going to be in the uses. Okay, so whatever you put in, you can see these match, and I have changed the assumptions around a bit since we first started. Everything still matches up, so that's great. So that's the sources and uses. This is the first model I've done that does this, and for real estate modeling in general, this is very good, especially with new construction. So I've got, in my mind, I've put the best assumptions for either construction or acquisition all in the same model without too much complexity. I feel like this is manageable and flexible. It's just not that hard once you've followed along. Okay, so I believe that's pretty much everything about the model. I'm going to save this, and this will be the default version. If you do purchase it and download the template, you can put in all your own assumptions in the yellow boxes. But that's the model. We've got sanity checks down here as well. Right now they're all zeroed, which they should be. This is just making sure all the different tabs and summaries all equal each other, because they should, because it's based off the same cash flow. If you do want to purchase the template, it will be available for a one-time cost. I think I'm just going to go $75 on it. I think that's pretty affordable for the majority of people, and it's super useful. I mean, to build this from scratch for somebody with these specs, it'd probably take me between $1,000 and $3,000 worth of time. But here, you can get this template as it is for $75. I will put it at smarthelping.com. So here's the website where I build all my, or you can download all my different templates. It'll be in the real estate section, and I'll put it right under underwriting templates. And you see there already is a hotel. This is the base that I just used for what you see today, but this is the original, which will still be available if you want, but this new one is going to be available. I don't know if I'm going to do a new web page for it, or keep it on the hotel model and just say an advanced version for $75. You know what? I'll probably do the advanced version for $75 as a button, and then I'll probably do an entirely separate page that explains the hotel model I just showed you guys in detail, as a separate purchase page as well. That probably makes the most sense. Remember, you can hire me, $275 an hour, to build whatever you want. I'm pretty available. I do quick turnarounds. Also, if you want to buy in bundles, if you go to the home page, real estate, you can get all the real estate models, not just the hotel, for $299. There's a whole bunch of really interesting things in here. You can also go to the Super Smart Bundle right here in the template bundle section on the right sidebar. And Super Smart Bundle, you can download the entire library of Smart Helping for $4.99, and that includes well over 200 unique financial models. These are all things I've built over the past decade. So that's a quick jump start to your finance career. If you're willing to learn, there's a lot of things in here that can teach. All right, like and subscribe.